Hello, everybody. My name is Kim Thomas. I work for Marcotte Retirement Plans. What I'm going to go through today is I'm going to go through what our role is so you best understand how we function and what our role is in dealing with your plan. I'm going to go through highlights of the liquid trucking plan so that you understand the plan so you can best utilize it in getting prepared for retirement. And then I'm going to talk about the Roth provision that is built into your plan so that you can decide how, if you want to utilize that as part of your planning for retirement. I'll also then at the end kind of wrap up and give you some resources so that if you have questions or concerns down the road, you kind of know where to go. As far as our role at Marcotte, all we do is deal with retirement plans. We don't do any individual selling of any other types of products. All we do is deal with retirement plans. We work with your committee there at Liquid Trucking to make sure that the plan remains compliant, to make sure that the fees are in line. We go through each individual investment every quarter to make sure that those are performing. So on occasion, you may actually get a notice that says this fund is being replaced by that fund. That's us working in the background to not only make sure you have investments, but you have investments that are performing well. And then we're also a resource to you. So if you have questions about your account or your investments or whatever it may be, we want to make sure that you know at any given time you can contact us and we will either get you the answer or direct you to the source of the answer if we do not have that. So that's our role. Now your plan is with American Funds. That is what's called your record keeper. So that's whose website you'll use. That's who produces your statements. That's who keeps track of your account. We don't work at all for American Funds. We just bring them to the table because American Funds happens to be the best fit for the liquid trucking plan at this point. So that's our role at Marcotte. As far as the plan here at Liquid Trucking, you can see if you are 21 years of age, once you have completed 6 months of service, you will be automatically enrolled at a 5% deferral rate. Now, if you want to change that, you have the option of changing that. But what the plan sponsor is doing is saying, you know what, we know retirement is important. We know it's important to get people started. So we're going to automatically put them in the plan unless they tell us differently. And we think this is a fantastic move that your plan sponsor is employing with this plan. Now, as far as what you can contribute, for 2020, you can contribute up to $19,500 of your pay into the plan. That has nothing to do with growth on the money. That has nothing to do with what the liquid trucking is putting in. That's literally how much you could defer out of your check throughout the year. If you happen to be 50 or over, you can put an additional $6,500 in. So if I'm 50 or over, I can put as much as $26,000 of my pay into the plan this year. Contributions can be made in one of two ways or both. They can be made in a pre-tax or an after-tax or what's called Roth contribution. So pre-tax contributions, if you're putting money in a pre-tax format, basically what's happening is your contribution is coming out of your pay before you pay taxes, goes into your account, gets deposited, grows tax deferred, which means you're not paying any tax on it while it's growing. And when that money comes out at retirement time, you will pay taxation on it at whatever your respective tax bracket is. The benefit of putting money in pre-tax, the initial benefit is I lower the amount of income I pay tax on. So if you're in a situation where you need or want to reduce your taxable income, putting it in pre-tax may make sense. Roth contributions are made with after-tax dollars. So if I'm putting my money in a Roth format, I would pay tax on my income, then my contribution would come out of my pay, go into my account, grow tax deferred, but that money and all of the growth on that money at retirement time will come out tax-free. I'm going to go through an example of Roth in a little bit of detail, but that is in essence the difference between the two. One, I get the tax benefit up front, but I have to pay taxes down the road. The second, the Roth, I pay taxes up front, but I get the benefit of getting it out tax-free at retirement. And I'll go through that in a little bit of detail in a little bit. You do have the ability to put money in pre-tax and Roth. You just can't get above the $19,500 total or $26,000 total between the two, depending on your age, okay? Bear in mind, all contributions that are made by Liquid Trucking have to go in a pre-tax format. So if I'm putting money in Roth and they're putting money in as well, I'm gonna have one account that'll have two buckets of money in it. Part of it will be the pre-tax money that they're putting in, and part of it will be the Roth money that I'm putting in. And you should be able to see that on the website. It should be clearly delineated, showing the differences, so that when you get to retirement and you want to take money out, you will have the option of taking money out of the pre-tax side, paying tax on it at that time, or taking money out of the Roth side, in fact, paying no tax on it at that time. So it's clearly segregated as far as in your account. But again, it's just one account that'll have two buckets of money in it. As you can see on the screen, rollovers are available. So if you have a retirement plan from a previous employment engagement and you can roll that into the plan. Now, the benefits of that, I think, are twofold. One, simplify your life. Rather than having an account here and an account here and trying to figure out how one is invested versus how the other is invested, you simply put them together and you just manage one of them. So you kind of simplify your life. But two, maybe more importantly, from a cost standpoint, I think the costs inside your retirement plan many times are going to be lower than you can go out on the street and get on your own. Something for you to check on. If you want help with that, I believe American Funds will help you with that process, but something for you to consider if you do have a retirement plan from a previous employment engagement. Now, as far as what your employer contributes to your plan, once you've been there, again, 6 months, you are eligible. And Liquid Trucking is going to make what's called a discretionary matching contribution, which is currently 50% of the first 5% you defer. So if you put in 5, they're putting in 2.5. You put in 4, they're putting in 2. You put in 1, they're putting in 0.5. So they're going to match 50% of the first 5% you defer. So for you to get all of the matching money that's available to you, you need to defer 5% on your own. And we encourage you to at least take advantage of all of that matching money. Now, oftentimes we get asked, how much do I need to save? And that's hard to determine. That's kind of a case-by-case situation. But for a goal, what we try to tell people is you need to try to get to where you're saving 10% on your own. Forget what your employer is putting in, but if you're putting it in 10% on your own, putting into a diversified portfolio, and you leave it alone until retirement, you'll probably be on a pretty good track towards retirement. But at least you want to take advantage of all of that matching money that's available to you. Next thing is vesting. Vesting says, okay, I have money in this account. If I leave Liquid Trucking, how much of the money is really mine? How much would go with me? So you can see on the screen, you are 100% vested in your contributions, any rollover contributions, and any earnings on that money. The money that comes from your company contributions has a vesting schedule tied to it. Now, it is tied to your years of service. So it's not tied to when you got in the plan. It's not tied to when the money went in the plan. It is tied to your years of service. You can see there, if you've been there 6 years or more and you leave, all of the money will go with you. Not only what you put in, but everything that they put in. If you have been there less than 6 years and leave, part of what they put in may not go with you. You should be able to see that on the website. It should show something along the lines of total account value, total vested value, and if you've been there 6 years or more, those numbers should be equal. But we want you to be aware of that so that you understand if you do have to leave, how much will actually go with you. Now, as far as when can I take money out, you can see I just talked about separation of service. I just talked about that. Of course, at retirement, you can take money out. This plan allows for what's called an in-service distribution. So if I am 59.5 or older and still working and I can make a withdrawal out of the plan without any kind of a penalty. In all likelihood, I'll probably have to pay tax on some of that money or all of it, but I don't have a penalty to worry about. Financial hardship, this plan allows for what are called hardship withdrawals. So if you get yourself in a tough place economically, you're going to be foreclosed on, you're going to go bankrupt due to medical bills. There are some other criteria. You have to apply for a hardship withdrawal. You have to be approved for a hardship withdrawal. There are usually some negative tax consequences to a hardship withdrawal, but you can do it. If you go on total disability, does not matter what age you are, you can get money out without a penalty. And at death, you will not receive anything, your beneficiary will. You need to make sure your beneficiary on your retirement account is correct. these function by contract law, so your will can say whatever it wants to. Whoever you have named as a beneficiary on this, that is how it will pay, irrespective of what your will says. So you want to make sure your beneficiaries are correct on your retirement plan. And then the last thing, the plan does allow for loans. In the way in which loans work, the maximum is $50,000 or half of the vested balance, whichever of those numbers is lower. That's the maximum amount you can get. So that's how your plan works. Hopefully that made sense to you in going through that. And now I want to talk about Roth and kind of go through the concept of how Roth contributions are utilized, and you have to kind of determine, does it make sense for me? So first off, I want to talk about, this is not a Roth IRA. This is a Roth provision inside your 401k. One of the big differences is inside your 401k plan, there are no income restrictions on contributing to the Roth portion. There is if you went outside. So let's say you walked into a local brokerage firm and said, I want to buy a Roth IRA. If your income is too high, you cannot do it. There are laws around that. But inside your 401k, you can be a very high wage earner and you can still contribute to the Roth portion of your 401k, which is actually a benefit. The next benefit of the Roth provision inside your 401k is the ability at retirement to access pre-tax and or tax-free money. So your situation is you get to retirement and now you need to take money out. And if I have some pre-tax money and I have some Roth or tax-free money, and I need to take money out to live on, to actually supplement my Social Security and part-time work or whatever it may be, I need to take some money out. You will have the ability to say, you know what, let's say I need to take $10,000 out. I could take $10,000 out of the pre-tax side, pay tax on all of it. I could take $10,000 out of the Roth side, pay tax on none of it. Or I could take 5 out of the pre-tax, 5 out of the Roth, effectively get 10 and pay tax on 5 of it. It gives me as a consumer some flexibility and some choice and some options at retirement. And I will tell you as an advisor, one of the very first questions we get asked when people sit down in retirement time is, where should I take money from first? And if it's all pre-tax money, from a tax standpoint, it really doesn't matter. It's all going to be taxed the same way. But if I have some pre-tax and some tax-free, I can kind of control my situation a little bit. Next advantage is control over when the Roth money is accessed, if ever. If I have all of my money in pre-tax, in a pre-tax situation, at a certain age, whether I need it or want it or not, I have to start taking distributions from it. They're what are called required minimum distributions, RMDs. But if I have money in the Roth portion of it, I can position that where I never have to take it out if I don't want. Now I know I can get it when I want. I know I'm not going to pay tax on it whenever I do. But if I don't want to, I don't have to take it out. Whereas with the pre-tax money, it is forced out. You actually have to take it out. And this bullet kind of lends itself to the next advantage, is the ability to pass Roth money on to heirs without tax consequences. If I have money in my retirement plan and it is a form of Roth dollars and something happens to me and I leave it, say, to my child, they would not pay any tax on it, nor would any other beneficiary that receives Roth money. That's one of the benefits. Now, I think that's kind of an estate planning benefit more than it is a retirement planning benefit for you, but it is a benefit. And then the last thing you need to ask yourself, it's a simple question. It's not easy to answer, but it's a simple question. You have to ask yourself, between now and when you retire, do you think your taxes may go up, down, or stay the same? If you think you may end up paying higher taxes down the road, it may make sense to pay the taxes now with the ability to get the money out tax-free down the road. So those are some of the advantages I see to Roth. I'm going to go through an example which will hopefully clarify kind of how it works, so that again you can decide if you want to employ this in your planning. So I'm going to utilize what's called the Rule of 72, and all the Rule of 72 is a financial calculation around compounding interest. And basically all it does is it tells you how long does it take for a sum of money to double in size. That's all it does. And this can be applied to any type of a financial instrument. So here's a situation. Bob comes to the meeting, and the guy from Marcotte sounds like he knows what he's talking about. So Bob says, you know what? I'm going to put money into the 401k plan, but I'm going to put it in the form of Roth dollars this year. So throughout the year, paycheck, 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 Bob puts money aside, and it ends up being $5,000 he's put into his retirement account throughout the year. Okay. He has 36 years until retirement, and we're going to assume his account earns 8%. Okay. The way in which the rule of 72 works is if you take the number 72 and divide it by your interest rate, in this case 8, the answer 9 is the number of years it takes for a sum of money to double in size. So we're going to assume Bob puts $5,000 in this year throughout the year. He gets to the end of the year, for whatever reason, he stops putting money in, but he's got the $5,000 in, it's in the form of Roth dollars. In Bob's case, here's his situation. So he's put the $5,000 in. The downside to him is he had to pay tax on that money before it went in. But if Bob's account earns 8% per year, in 9 years, his $5,000 will be $10,000. In 9 more years, that will be $20,000. In 9 more years, again, if it's earning 8%, that will be $40,000. And in 9 more, or 36 years total, his account will be worth $80,000 total. So here's his situation. He put $5,000 in. Again, the downside to him was he had to pay tax on this before it went in. He has $75,000 of investment growth in this scenario. He gets the $5,000 out tax-free because he already paid tax on it. And because this $75,000 is Roth money, it's deferred growth, but it's Roth money, he gets it out tax-free as well. So he gets all of the $80,000 out tax-free. Now, I believe you need to assess your own personal situation to make the decision as to whether or not it makes sense for you to put money in Roth, or maybe it makes sense for you to put money in pre-tax. And again, your situation can change over time. So you're not stuck with either one of these. You can make a decision to put it in pre-tax, change it to Roth, or vice versa. You can change that. Or again, you can put money in both sides. So if you want to put some money in pre-tax and put some money in Roth, you have that ability. Again, your only limitations are those IRS limits of $19,500 or $26,000. So hopefully this helps clarify this. We just want to make sure you understand how it works. So again, you can decide, does it make sense for me to employ this in my retirement plan? Now, just to wrap things up, utilize your plan benefits. You guys have a very good plan at Liquid Trucking. You've got a good match. You've got the ability to put money in pre-tax or Roth. You can get in pretty much right away when you get started. So we think you have a very, very good plan. It's running very efficiently from our standpoint. Try to get to 10%. I always tell everybody it's easy for someone like me to tell you to put a bunch of money in your retirement plan. I don't have to pay your bills, but I can tell you the sooner you get money in your plan and the sooner you continue to try to increase that, the better position you're going to be when it comes to retirement. Consider Roth. Maybe it makes sense in your situation, or maybe it doesn't. If you need to reduce your taxable income, put it in pre-tax. Maybe that makes sense. But if you can afford to pay the taxes, I think there may be an advantage to having some tax-free money at retirement. So at least give that some consideration. Seek professional assistance. If you have an advisor that you're working with, consult with him or her. Maybe they can give you a little bit more guidance. If you want help, if you don't have an advisor, if you have some questions you'd like to bounce off somebody, by all means, you can contact us at Marcotte. I've got the numbers on the screen. That is the numbers for our office. Again, my name is Kim Thomas. You can feel free to call us at any given time. We will do our best to get you the answers to your questions. So with that, I will wrap up and hopefully talk to you down the road. Appreciate it. Thank you. Bye.